Hi everyone, and welcome to our live webinar, The Future of Asset Management. I'm your host, Christian Lindvall, Global Commercial Director here at Performativ, and we are thrilled to have you join today. So we know that asset management is at an inflection point. Technology is often moving faster than firms can keep up with. Regulation is becoming more granular and demanding, and clients are certainly expecting more personalization, more transparency, and instant access. In addition, fee pressure and commoditization continue to erode the traditional setup. So that's exactly what we'll talk about today. Where does that leave us, and where does that leave the future of asset management? We will start with an introduction of our two very esteemed guests here shortly. We'll move into a moderated discussion, and then we will go to a Q&A. So feel free to pop in your questions as we move along, and we'll get to those right at the end. Without further ado, I'd like to introduce Jacob Dahl and Jesper Kirstein, and we'll hear from them on a quick intro. Welcome both.
Thank you very much.
Thank you.
Should I start?
Yes, please.
So, honored to be here. I'm Jacob Dahl. I started out my career in research and trading. I had the privilege of working with Jesper. I guess we'll come back to that. In predominantly Danish/local investment firms. And then I joined McKinsey back in '94. And I even tried to start my own bank in 2000, Basis Bank. Some of you might know it. And that went very well, and then it went not so well. And I rejoined McKinsey in 2001 and basically stayed there for another 23 years. And in McKinsey, I mostly or predominantly worked with financial institutions, banks around the world, asset managers, a bit of insurance, but predominantly, I would say, banking and asset management. I've been working mostly in Europe, and I then became responsible for the EMA part of McKinsey, which is Middle East, Africa, Turkey, Russia, Ukraine, etc. And then I moved to Hong Kong to lead our financial sector practice in Hong Kong, and traveled throughout Asia for 4 or 5 years, ended in 22. And then since 22, I'm predominantly doing two things, board work, and there I'm honored to be a member of the Danske Bank boards. I'm heading up the risk committee, but also some smaller fintech players where I'm chairing some very exciting companies. And then I'm also advising some of my own portfolio investments around the world, some of them in Africa, some of them in India, etc., etc. So that's what I'm doing.
Fantastic. Jesper.
Well, thank you for inviting me. I have been in the financial industry close to 50 years. I don't like to think about it, but it's true. I started out my career in the Central Bank of Denmark and moved on to OECD in Paris, where I worked as an economist. Came back to Denmark, slowly migrated into finance, traded currency in the now bygone Handelsbanken, and then moved to a small stockbroking company where I had the pleasure of meeting Jacob, and we had some really fun and interesting years together, building what I still think was a great company. I then moved on to Almindelig Brand Bank, where I was CEO for a very short while, where I was kicked out. And I used to say, well, it's not a shame to be fired. It's not necessarily you who's stupid. And then I moved on to another place where I got fired as well. So I started my own company in 1993. And that slowly developed into two arms, an investment management company and a consultancy. The investment management company I sold in 2001 and continued a bit with the consulting company, but closed that down in 2023. Did I say 2001? I meant 2021. Today I am mostly retired. I do the odd thing. I have an interest in a few startups, and then I do a bit of consultancy work, but mostly I play golf.
That sounds fantastic. Thank you both for the intros. I have to go back maybe a step also because you alluded to it, both of you, that you worked together in the past, so I'd love to hear maybe you guys expand on that a bit more. What was that experience like? Have your professional paths crossed again through the years?
I joined the investment world in, I think, 84, 85. And for those of you who've seen Wolf of Wall Street, it was pretty much like that. I felt I was the only intellectual or trying to be intellectual in that environment until I happened to run into Jesper. So Jesper was the first one really challenging me on sort of the academics and the intellectual, and I love that. I mean, imagine sort of a professor character in the Wolf of Wall Street. That it's a bit of an odd concept, but it actually helped me. So Jesper was a great mentor for me for those years.
So, teacher, student.
Well, it started out that way. It developed. I mean, we tried at that stockbroking company to build a more research-driven attitude to trading. And Jacob started out working in our research department, which was a new thing to stockbroking at that time, I would say. It didn't exist. But then I have to say that he had a lot of talent. So he ended up being head of our fixed income department. And in fact, didn't you get CEO of the stockbroking company?
Yes.
Eventually,
I did.
at a very young age.
Yes, exactly.
Yeah, very cool. And then did your paths cross as you moved forward in both of your careers?
A few times in connection of startups and a few discussions as well. So yes.
Yeah.
And then in this.
Yeah, that's
So
why we're
great.
so excited to have you guys
exactly,
here today. So maybe again, taking a look back, staying a bit in the past, you've seen the industry, the asset management industry evolve a lot over the years. What would you consider the most pivotal moment or shift that you've seen where it had real impact on the industry?
Should I start on that, Jacob? And then in one of the companies I had, the Kirstein A, we were advising, just to give you a bit of background, we were advising asset managers on their strategies based on data, based on what investors said. And I think the biggest explosion we really had at the time was the ESG. If you go 5-6 years back, our discussions with asset managers completely centered around how could they create products that were ESG compliant or impact driven, and we spent a lot of time with that. And I used to say at that time that ESG was really a present to the asset management industry because it required scale and competence, and asset managers could really add to that. Having said that, I would say that now ESG has taken backseat to some extent. I'm not saying it's gone, but it doesn't have the importance that it had at the time. So today, I would rather say that the biggest development that I have seen is the move to passive, or you could say the barbell strategy of the move to passive on listed assets and then moving into the private markets, both, of course, for institutions, but also for other investors.
Yeah, I basically echo that. I think the whole revelation that active managers are struggling to beat the index, I mean, which became increasingly clear over the last 15, 20 years. And if you look at the number who actually beat the index over a 3-year, 5-year, or 10-year period, it's so little and it's not predictable. So the whole move to passive for me is the biggest historic move, grounded in a very real thing about lack of performance.
Yeah.
Yeah.
Maybe going back to the ESG element, what do you think the shift away has been from that? So it was important 5-6 years ago. Why is it becoming less important now in your estimation?
Well, let me start with that. I mean, at the time, the narrative was that you could be ESG compliant and perform just as the market or even better, that ESG would in fact support your active management. And it turned out that it was not exactly like that. And we have seen in the last years that ESG has been a detractor to performance quite significantly at that. And I think that's probably the main reason that ESG is not as important as it used to be. I don't have to mention any particular companies, but you can think of some.
Yeah, and I agree, and I think there's a nuance. I think for some segments in the market, it's still very important. For others, it's not. So on average, it's gone down. But I mean, it would be foolish to say it's out or it's reduced, because there's still, if you want to cater to some segments, it's still very, very much on top of the list. And we can come back to that later.
Yeah.
Yes.
Perfect. Well, then maybe let's shift from the past to the present. We'll talk a bit about strategy, scale, and survival. Three very important elements. So there's a lot of new entrants, more regulation, a crowded product market, and asset managers are under, I would say, a lot of pressure to define where they play and how they win. So in your estimation, who's best positioned to succeed? Is it the global giants or the more focused specialists, and why?
Again, it's a nuanced picture. I think there's a lot of forces pointing in the way to scale, especially for the passive plays, right? So, which you see that the bigger are winning, both in pure passive, but also in smart beta products. So the likes of BlackRock's, Vanguard's, et cetera. Having said that, there is obviously a limit to the growth of passives, and I think the whole discussion about technology shares in US is more or less centered around that as well, right? Of course, there are elements of a bubble, but the bubble are predominantly also maybe created by these index investments, so which becomes self-reinforcing. So discussion is obviously, to what degree can you keep on growing passive? Is it 50, 60, 70%? We are probably close to that point, right? Which leaves room for alpha players. On that side, the alpha players is also facing challenges, right? The challenge is obviously that distribution gets more and more concentrated, so you need new distribution strategies in order to be relevant. There is a trend towards, you can not only be good in one alpha product, you probably need a little bit more broad solution-based propositions. So there are forces against the mid players as well. But to answer your questions on a high level, I would say there are room for both. There are different forces pushing in different directions, but there are definitely room for growth, but very much depending on which strategy you're playing.
And maybe if I should add to that, I think the big index players should think about the story about the Scotsman who tried to teach his horse to live without eating. And you know, when it finally learned it, it died. What I'm trying to say here is that your fee can be so low on your passive management that you can't earn money anymore. Because it's becoming a commodity.
Yeah.
So I think that the large index players should also try to use their scale in a number of other areas. One area could be solutions, as Jacob alluded to. And solutions could be very, very many things. It can be risk management systems like BlackRock and Aladdin, but it could also be creating dedicated strategies for large investors that they can use in a very specialized fashion in their strategy. So we need something which is sensitive to this and is targeted to that. And I think the big managers have the force and the scale to do so as well.
Makes sense. And maybe that leads us to the question of scale then. At Performativ, we're often working with asset managers who are trying to navigate growth while also trying to modernize their operations. That's a delicate thing, I think, for a lot of them, and it's very rarely smooth sailing. So on that note, what, in your estimation, is a strategic misstep you often see when asset managers attempt to scale or modernize?
Can I start on that, Jacob?
Yeah,
then you can follow up. We've seen it so many times that asset managers have a successful strategy. They love it, they earn a lot of money, and they pile more money into that strategy, and eventually they can't perform on that strategy. And let me mention Standard Life's GARS product. GARS was a very successful product, and whenever there's a problem, Standard Life would simply say, okay, you take a certain amount of GARS and everything is done. of course, it did not turn out that way, and Gas was, I think, losing so much money. I think it's closed now, eventually. But there are very many examples of scale or size being a hindrance to performance. And so you have to be very, very fine-tuned to say, okay, now we close the strategy. And then they keep it open anyway.
And let me add to that, because I think I very much agree with that, but there's another side of the scale, which is proliferation of strategies. And I've seen a lot of players where probably in a answer to customer request, they are launching too many small strategies. So you end up with 100 different strategies with one asset manager, or 100 plus I've seen in some instances. And that's not the only problem, because it gets complex and every fund gets too small, et cetera, et cetera. But then the second derivative is that most of them are actively managed, right? Even you can say a Danish pension fund being active in global equities, does that make sense? Probably not, right? So whereas, because you need the competence to be active if you're not either outsourcing it or just in index investing. So I think the scale also goes to the proliferation of too many strategies and being active in too many strategies.
Mm-hmm. Maybe taking a step back to what you said around, they have a strategy, it's working really well, but it often sounds like adapt or die, and a lot of times die happens. But how do you mitigate that where it's going so well, you're sort of getting fat on that strategy, so to speak? How do you monitor that, moderate it so that doesn't happen? I
mean, when you do a due diligence on a manager and it's a successful manager, that's one of the first questions you ask. How will you mitigate growth and scale? And they will also have very fine strategies for that, and they will measure how much any stock will have as a percentage of the circulation. But it's in the end, it's like selling elastics in a meter size. It's very, very difficult to say no when you know that you can have 1% of the new one. But it is possible to mitigate, and of course there's been strategies where they've done that successfully. But I can think of more strategies where they haven't.
Yeah.
It also depends on how niche your strategy is, because if you have a strategy in a very deep market, take global equities or take some FX indices, et cetera, there's probably more room for scale than if you are a niche alpha player in Danish mortgage bonds, for example, or the like, right? So I think there's a depth of market element to this.
Yeah, makes sense. Fantastic. I think maybe we can switch over to tech, transformation, and talent. I think that'll be the next topics we discuss. Technology is clearly driving much of the change that we're seeing in the space right now, from AI to automation and advanced data tools. Obviously, the potential is very, very exciting in this space, but not everything lives up to its promise just yet. I think we're seeing that quite often. So which technologies do you actually think will move the needle in the next 5 to 10 years in this space?
Okay. So first of all, I don't think we should underestimate AI. I know some areas of AI might be hyped at the moment and some not, but I have a huge expectation that this will fundamentally change the industry. Both on the cost side and going back to scale, AI is one of the elements which actually could make smaller players competing effectively with larger players as well, right? If you look at reporting, if you look at research, if you look at customer communication, personalization, et cetera, it's really an area where you can get costs down with AI. The latest estimate I saw from my old firm, McKinsey, is 40% down on cost for asset managers, right? Based on AI. The other element is the revenue. You are now able to personalize the offering in a much more tailored way than you could have done before, right? Which eventually would have revenue effects, right? So I'm a big believer in AI, in financial services, and in asset management. The two other techs I would mention here is quantum computing, which I think will come for real over the next 3 to 5 years, which were your time horizon. And that I think will open up the opportunity for quant strategies to really outperform the market. I mean, already now we have computer power, which is quite unbelievable compared to what we had 5-10 years ago. In 5 years, we have incredible computer power. If that cannot compete with the market, I would be surprised, right? So I think quant strategies in the future will play a more prominent role. And the second aspect I would say is the whole thing about stable coins, which will make the money flows in and out of funds, etc., more transparent, more easy, faster, same time delivery instead of longer horizons, right? So those two other technologies will play a role in the asset management as well. But AI is big.
Yeah.
But just to add to that, I completely agree with what you're saying. It surprises me that the industry has not embraced or created strategies by using AI and quantum computing. Mm-hmm. It's surprising. I mean, the big players should be able to create products that could outwit most active products. I personally believe, and excuse me for that maybe too many people in the financial industry are average. And it is so easy for a computer to outperform the average. You have to be really, really good, a human, to create performance. And with the computer power that you have today, it must certainly be possible to create strategies that can perform. Mm. And you haven't seen them. I saw a product that BlackRock was doing out of San Francisco, the old BGI, office. And that was quite interesting, but that was many years ago. And honestly, I don't know where it is today, but I would have believed already at this point of time that there would be strategies who could outperform, like you're saying.
Yeah. And the other thing is, I actually invested in one quant product, and the performance was okay, but there was a diversification effect, which was also because it was so contra the market. Yeah. So you get a standard deviation effect, which is also positive. It's not only about performance; it's actually also to hedge your portfolio in some sense. Right? But
that's an interesting point. The maybe resting on their laurels in the financial services industry. What do you think informs that? Maybe for such an ambitious culture in so many ways, that lack of ambition in getting ahead of things from a technology perspective. Where does that sort of mindset lie in that space?
I think there's a lot of inertia in most institutions. I do think. I mean, also sitting on the board of Danske, we are grappling with. I mean, we are doing a lot of experimentation. Everybody believes in the potential, but nobody really understands where it is. I mean, we are still experimenting, right? And we have seen some very successful use cases, but we need to scale them, etc. I think we are slowly spreading into a new territory where nobody really sees a solution. So therefore, experimentation, but we don't see the big leaps yet, right? Yeah.
The funny thing is, at some point we all thought that smart beta or risk premium strategies would do the trick. So everybody started making strategies on the traditional risk premium. It could be value, it could be momentum, it could be low vol. But what has happened? These strategies have not performed for a long time, which might have deterred somebody from developing more strategies. I mean, I personally believe, you could do studies 30 years back, 40 years back, and showing that low vol has been outperforming the index with a lower risk, etc., etc. It hasn't happened for a long time. Yeah. You can go to Nordea and see how their stable return equities is doing right now. It's not. For a long time it was their most successful strategy, and today maybe not.
Okay. Yeah. So we're seeing this tension in our work at Performativ. It's this where clients are again trying to strike a balance between increasing efficiency with technology adoption, but also very importantly trying to maintain a human touch. So we talk about this a lot every day that we're having this conversation. So this is maybe my favorite question of this whole session is, do you believe the industry's future is still human, or are we headed towards full digitalization at some point soon?
I think we are heading for both. I have no doubt that machines in many of the processes, both obviously the compliance process, research process, are more effective than most humans. And on the investment side, I have no doubt as well. And this quantum computing we talked about before, maybe that will even sort of increase that further. On the other side, I mean, both from a customer connection angle, I think the human touch will still be important for many clients to have that overlay. But frankly, also from a regulatory level, that there will be a demand from regulators that humans are in control of some of the machine processes. Otherwise, they will not accept the institution. So I think there will be a mix, but I have no doubt machines will take more and more of both the more basic work, but frankly also the investment work.
I think I agree again with Jacob, but I think that we will need a lot more employees in the financial industry. What we should be looking for is the real talent, the 10% or 5% that could do a real difference. The great guys, and guys I mean both men and women not to be misunderstood. And then there will be a lot of people who will be redundant, quite frankly. Look what happened to the banking industry. When you go 30 years back and we said, okay, we need people at the counter in the bank, the human element. I mean, how do we do the banking today? Everybody will do their banking online.
Absolutely.
And then they will need a human touch every once in a while, but very rarely. Had we said that 30 years ago, nobody would have believed it, but that happened. It's going to happen in the financial industry as well. And then we should really focus on the real talent in the industry. And of course, somebody who can control that the computers are not doing silly things.
Yeah. It's funny when we look at consumer behavior in the bank, we've always had the question of, I mean, there's always the 50 plus generation, but there's also the digital native young generation, I mean, 20, 30, 35 maybe. When they are facing a complex problem or complex new thing, buying a house, signing their first life insurance, getting deep into asset management, etc., they really strongly prefer a non-digital human solution, somebody to talk to, somebody to hold the hand, right? And you can have a lot of effective chatbots, etc., but still prefer that, especially in the first moment of truth, maybe in the second moment of truth, and then maybe you can make it more digital, right? But it's interesting to see even the young generation really wants this human touch.
But can I ask you a question, Jacob? How would you use, digital solutions to support the humans that will then advise the consumer?
So I do think that the idea of having a lot of people who meet the bank or the asset manager or the distribution have done a pre-work based on digital solutions. So they know roughly, I mean, they are educated and they know roughly where they want, and they just have the final questions, right?
Sure.
By the way, they have the same tools as the advisor will have. So they're looking at the same systems, which is super important because then you have that confirmation of what the machine actually says is right in your situation, or there might be a few twists, right? So I think the digital tools can take some of the robotsarbejde, some of the basic work out of the portfolio choice or the mortgage choice, etc. But the final, this looks okay, would be sort of a human element, right? So it again, it's co-work between machine and man.
One of the things I experienced was that digital tools can also help giving both the bank person, the advisor, a fantastic overview of an economic and financial situation for an individual that they don't have themselves.
100%.
Yeah.
Perfect. Let's switch into, you mentioned it before, regulation.
Yes.
So regulation and risk. We are having these conversations pretty often with asset managers, adjusting to DORA, SFDR, so a lot of the new regulations that are coming in. How should asset managers think about regulation today? As a constraint or an opportunity?
I mean, first of all, regulation is here to stay, right?
Yeah.
So we have to live with it in the industry. I think if you really take the essence of, and there are many regulatory systems, and they're both EU-based, they're even global, and then there are the locals, right?
Mm-hmm.
They're all pointing to treating the customer fairly and creating more transparency, etc. And I actually think that is super healthy for the industry. What it does is that it's easier to be a good performer, and it becomes more difficult to be a bad performer. In the old days where you have retrocession fees, you still have it to some degree in many countries, including Denmark, but it's abolished in Holland and UK, and the trend is generally down. But in the old days where you had this, it's easier to hide bad performance via big retrocession fees, right? And it was a more blurred world. I think it's actually becoming more healthy now, where good performance is actually now transparent and bad performance is transparent. Having said that, I mean, it is also exposing the asset managers in the sense that they only have to, I mean, they only have the performance, and what else can they do now? I mean, of course you can say you can add layers of service to it, but what kind of services, right? So you are very naked, especially if you're only average performing. How do you actually get through that distribution layer and convince everybody to use your product? So you're more naked than before. It's more difficult, but it's clearly warranting or benefiting the good performance versus the bad performance, the whole regulatory aspect.
I think that's true, and maybe a bit new to me. I was always a bit, I say, negative towards regulation. I witnessed what was happening when the ESG regulation were introduced, 5 years ago or something like that,
Yeah.
with different kind of grading of funds and all the misconceptions that gave rise to, I mean, people should define their own funds. I mean, how stupid was that? So I think that the regulators have to be very clever when they design the new regulations. And ESG was a very bad example of that. That's one thing. Another thing in terms of asset managers is that I think there's a big difference between the larger asset managers and the mid-sized asset managers, where the larger asset managers, of course, they have to deal with it themselves, whereas the mid-sized or smaller asset managers can outsource a lot of stuff. And I think they should think about outsourcing many different things of what they do. It could be, of course, reporting, saying this to please you, but it could also be compliance or things like that. And I do believe that there will be introduced quite a lot of different platforms that you can use in terms of that. And I think, again, different providers can work together in providing a total platform for small, mid-sized asset managers.
Yeah, and I think related to this, regulation isn't necessarily just a tick box exercise, right? I mean, it's also about managing risk in a broader sense. Mm-hmm. So I think we've certainly seen how even operational blind spots can lead to reputational damage. And I think with that in mind, my question is, what are the blind spots asset managers face when it comes to operational or reputational risk?
I mean, we had an example of it in the bank where we had, for those of you who are Danish, the Flexinvest case, right? Which speaks to the operational risk of designing an asset management product, where you need to be 100% sure that it is in the customer's best interest. And if you design the product in a positive interest environment and the interest rate environment drops below zero, the logic might change. And even though you have the product on the shelf, you shouldn't sell it because it's not in the customer. But this is a huge operational risk, right? That you design products which are not really in the customer's best interest, especially as macros change, right? So that's one risk. The other one is, I mean, we talked about passives. So the whole embedded ESG risk you have when you invest in passive. Yes, you can have clarifications to your ESG partner that we don't want to invest in these and those companies, but is there an indirect element in other companies which you expose you to? So if you say you have an Article 9 fund and you have a passive against it, are you 100% sure that your ESG manager actually are living up to that? Question mark, right? and that creates some headache. I mean, and even in where we are active, saying that we are supporting the transition to become more ESG compliant. Are we really sure we can do that when we are in general assemblies? Can we really affect the company from going from A to B with 5% of the votes? Unclear, right? And that again is a reputation or brand risk, because we are saying we can influence, but can we really? And when should we pull out? Question mark, right?
And the thing is that banks or managers are taking decisions on behalf of their clients in terms of ESG. And how can you be sure that all your clients will agree to the decisions being made? I mean, the most obvious example and recent example is, of course, defense industry.
Yeah.
I mean, 3-4 years ago, I mean, you couldn't invest in that. And today, of course, it's the opposite. We are seeing dedicated defense funds. Yeah. But it could be other elements. I mean, my favorite example was if, for instance, a Danish lobby organization invested through a bank and it was not allowed to invest in tobacco companies. Mm. But what if a tobacco company was a member of this lobby organization? What should they do about that? Yeah. So how can they be sure that this particular ESG strategy that they have selected will comply with the interest of the clients? Mm. And I think it will be necessary to slice and dice your strategies to satisfy different client segments. I don't know how you see that.
Completely.
Yeah, fantastic. Let's switch over to leadership, culture, and the next generation here. Because I think no amount of strategy or technology matters without the right people behind it. I'm sure you have found that in both of your careers. So in your view, what does great leadership look like in years to come? In the asset management space specifically, but also maybe in the broader financial space?
I think the topic of tech, which we touched upon, has changed from some IT head who nobody understood when he spoke in the board meetings or executive meetings, to it is an absolute must for everybody around the table to be at least savvy of all new technologies and what's going on in the industry. It's becoming a completely integrated part of banking industry, banking strategies and asset management strategies, very clearly. So you need a tech-capable leadership across the board. I also think you need a very agile leadership, which is both because of the geopolitical situation, etc., but frankly also because there's a trend towards more solution-based offerings from individual asset classes, and therefore you need to master sort of the whole spectrum of financial assets, and that might include new asset types, right? That might in the crypto, it might CO2 quotes, right? The whole slew of new asset types, which might be included. Royalties is a new one popping up as well. So whenever you have a stream of earnings, there could be sort of an asset around it, right? So having agile, and then I think there's an evergreen of leadership, which is, in order to be a good leader, you need to have followers. And if you don't have followers, you are not a good leader. And that capability of mastering, and to Jesper's point, I very much agree, increasingly professional, capable people is an evergreen which will last into the future.
Yeah, I was just going to say that the ability to spot and manage highly skilled individuals will be more important going forward. I mean, if you agree with me that there will be a big chunk that will no more be really relevant, then it's the really intelligent people that are important. That's one thing. Another thing that I would say is the ability to understand distribution. I mean, we don't have to look too far in another industry where maybe the ability to understand distribution was not good enough, and distribution will still be key in our industry. How will large managers distribute? How will the smaller managers distribute? I think that's going to be an increasing problem, and I hope you will add to that, Jacob. But knowing how to distribute, I mean, somebody asked me when I had my company for 25 years, I was interviewed by a journal, and the journalist asked me what was the biggest mistake I did for 25 years. And I had no doubt I didn't put enough weight on distribution. I thought that if the product was good enough, it would sell itself. You know what? It doesn't. And so therefore I think that to understand that the goods or the product should be distributed is very, very important.
I completely agree. And the problem that many are facing is that the distribution side is consolidating. And that means that you are small asset manager dealing with more and more powerful distributors. And how do you make yourself relevant? And for many, it is about developing a B2B to C strategy, which is how can you make the platforms or the banks or the IFAs or whoever is the layer between you and the end customer? How could you make them successful dealing with the end customer? So there's a continuous flow there. And distribution is key because, I mean, increasingly you are just one among many in a supermarket of choice.
Yeah.
And just adding to that, how can you adjust your product offering or your solution offering to accommodate the middleman in his work with the end client?
Yes.
I think
Yes.
I know there's a company in the UK called St James Place, working with a number of IFAs. I think that model, somebody is trying to do this in Denmark, but I think that model could be very, very interesting going forward. And then the end asset manager should think about how do we support the middleman, the B2B, and then to C as
Exactly.
Yeah. I think there's something about talent and hiring in this thread as well. I think you mentioned average is not going to cut it anymore, and I think it needs to be a mix of probably intellectualizing the space, but then also being very tech forward. So I think skill set wise, what do you think will matter most for the next generation of asset managers? Is it going to be that mix that I just talked about, or do you need to lean more heavily one way or the other, intellectual versus tech forward?
I think you need both. And then you can say, well, what's the future operating model of as a manager? And I think you will see, back to my costs example, you'll see dramatic sort of fewer people in some of the reporting. There might be outsourcing deals.
Sure.
I very much agree. The research will be focused, much more narrow with more specialists, but AI helped. So the whole operating model of an asset manager will change quite dramatically. Enabled by tech, but then you need the exceptional people on the investment side and on the distribution enabling side, and understanding what is really the end consumers' demand on us, and then we can help the middleman to be more successful with the end consumer. But it's a difficult situation because you are not. I mean, of course, if you're in an institutional space, you can be more directly B2C, so to say, right? But being B2B, it's a more complex, and you risk being marginalized and out-squeezed on fees, right? Especially because the distribution layer is going to be super consolidated.
The good client-facing employee is incredibly important, and one of their tasks is to understand the need of the end consumer. And how do you do this in a systematic way? How do you gather information from the consumers in a way that can then be put into new strategies or other ways of doing it? In my old company, we tried to do a little bit of AI already at that time. So we threw a lot of data into a machine and said, what is most important for the end investor when they select a strategy? Is that the performance, or is that something else? And it turned out that it was not performance, but it was the distribution, the knowledge. So it turns out that these people are incredibly important in selling the strategies. Surprising.
Fantastic answers. Thank you both for the discussion. I think it was great. I think now we want to hear a bit from our audience, who I think have been submitting some questions throughout the session. So if you're keen, we'd love to take a few of those and hear your answers there as well.
Of course.
Grab the tablet here. Yeah. So first one, what's one trend in asset management you think is overhyped and one that's not necessarily getting enough attention?
Can I maybe start? Let me start with a trend which might not have enough attention. I personally believe that having private assets in a portfolio is key. And for the institutional investors, it's not a problem. They can deal with all the capital calls and what have you. But to democratize these investments to the retail investor or to the small family office, I don't think there's enough products. I don't think there's enough strategies. Some of the open-ended private equity or whatever, I think are not good enough. And I think the industry should think a lot about how do we create strategies that could end up with the retail or the smallest investors. That's one. Maybe you could talk about the high.
No, I completely agree, and you can extend that to infrastructure. You can extend it to maybe even real estate. There's the whole tokenization of real estate assets, for example, which I think would naturally belong in a lot of. There are individuals who are not exposed to real estate, for example, right? I mean, how can they get exposed to real estate and the infrastructure, et cetera, et cetera. So I very much agree with the points on the more private high-end side. I don't think that there's any specific trend which is overhyped. I think the movement to passive is slowing off, and I think it will reach its maximum quite soon from here, to be honest. So it has been a very important trend. I think it's losing steam for a lot of good reasons.
Okay.
I would agree with you on that, and maybe just to add to that, I mean, the whole discussion about concentration in ETFs can be one issue. Another thing that sometimes puzzles me is that when you have asset managers that say, okay, we will supply ETFs, I mean, what's their value add? What's the value added in supplying ETFs to the client? They can do that themselves. They should think about, I mean, what's our value add?
Yeah. Question 2 here. Are there markets or client segments you believe are underserved today?
I think Jesper covered the clients who are underserved, and I agree with that. Especially, I think most family offices and very high-end private banking are pretty well served. I think the next layer of affluent, I think they're less well served.
Sure, I agree.
I think now I've worked in Asia for 5 years. I think, if you really look for growth opportunity, I think Asia is the one. And again, quoting some of the McKinsey, Asia would be bigger than the US in terms of asset management if you go 5-7 years from now. So it's a huge market. It's an underdeveloped market, etc. So I think from a geographic point of level, that is a lot of opportunity space. Yeah, I don't know if...
The funny thing was that when we worked with managers 5, 6, 7 years ago, they found out that some of the larger investors, one, they were consolidating. So there were fewer investors to target. Secondly, they were insourcing. So they were managing the money themselves. Thirdly, they were going passive. So what should they do? And then they talked to us, they talked to somebody else, and they all found out, okay, let's focus on the family offices. They didn't know who they were at first, but then of course they started to get more professional and they jumped upon the family offices. So I would say that today the family offices are probably overserviced, whereas the retail sector still, I think, has some way to go. And then of course there can be geographical areas where you could have a lot of work to do.
And you can say AI, it could be one of the unlocks, because in a bank, as manager situation, is always what is the opportunity to serve, what are the potential revenues of serving better versus the cost of serving better, right? And of course, with a family office, the amounts are so big that, the revenues can be obviously defending the cost you put into it. With AI, you can do personalization in a very different way, which means that you can lower the cost point and start serving the affluent in a very different way.
We have a very detailed question from Jacob. What does revenue and fee models look like in the future world? Retrocessions are disappearing, yes, but how can I build a high net worth wealth management business with profitable margins? And what should my USPs be?
And this was specifically me. I would love to give it to you.
Maybe we can break it into
You can start it. Then.
No. But I think it has to do with the distribution we've talked about, right? So I think there are two ways of answering. I think on the product side, you need to be smart on the solutions. So what are the solutions that you can tailor make, and when I say tailor make, personalize to the individual customers. If you're better in personalizing your products, I don't think the individual products are necessarily better than other products, but the way you personalize it and tailor make it to the client can be superior, right? Then you need to have excellence in distribution, and that means that your reporting, your compliance, your are streamlined, effective, correct, etc., and flow directly through to the end customer. If you're better in that service aspect combined with the solution-based products, I think you can demand fees which is higher than the average fees, right? So that would be my answer.
And maybe one point which is underestimated is what asset managers can do. They can simply, I used to say, we don't have to be good. We just have to be large enough to obtain cost fee reductions. And if we are willing to circle these fee reductions to the end client, and then on top of that put a reasonable fee, but where it's very clear that we will negotiate as well as we can with the manager a fee based on the volume that we have on all the clients. And then we can add to that. Sometimes it ends up that what the client pays in a fee to the manager is less than the savings they will have from being member of a club that buys wholesale from the manager. So I think that model is really important. Not everybody understands that, I think.
Yeah. Great. From Chris, any comments about asset managers moving into the new Web 3.0 economy of blockchain, digital assets, and especially tokenization of RWAs, real world assets?
That's for you.
No, as I say, I think there will be a whole slew of new assets coming attached to crypto, to stable coins, to tokenization, etc., etc. I think from being skeptic, if you take my own institution out of the bank, the Danske Bank, we've now joined a stable coin consortium because we realize that this is, frankly, also driven by geopolitics, because if the US, via the Genius Act, is now introducing stablecoins, which would be another dollar-dominant thing, Europe, again, it's squeezed out, right? So geopolitics is also governing it. So what I'm saying is that I think there'll be a lot of new assets. I'm personally very skeptical about Bitcoins and the cryptocurrency itself, but the technology about blockchain, I think, have a lot of virtue and value. So I think products which are like stablecoins, which are attached to the blockchain technology without being highly speculative as Bitcoins. Having said that, I acknowledge that Bitcoin is now an asset class, and you can like it or not like it, but it's there, and then there will be a subsegment where you probably want to have asset management strategies around it. So I do think that back to your leadership question, a leader of a modern asset management firm should have a view on where do we want to play in this crypto world.
Yeah, absolutely.
Yeah, I have to say I'm very skeptical. I fear that the bubble may burst, and that could be the end of managing of cryptos or the like. But it hasn't happened yet. So,
yeah.
But as somebody used to say, and that was back in the days, Jacob, if somebody is predicting that an 85-year-old man will die tomorrow and he doesn't die, is the likelihood of him dying the next day, is that less?
Was that you were saying?
I used to say that.
Okay. Just want to make...
He only quotes himself.
So another question from Jacob. What will the role of smaller wealth managers be? And then the follow-up. Can the large players support great service to their clients?
So can I take the second one first? I think the AI, the whole personalization thing is the way that bigger asset managers can get close to their clients, right? I think any big player will use this tool or try to use this tool to get closer to a more individualized service, right? The role of the smaller managers, I think it's confined to mostly alpha strategies. And I think that would be a super important role back to, exceptional talent going together with exceptional strategies. That will never die. And I don't see any trends that will die. The challenge for those, as I said earlier, is the distribution. How do you get your product well known outside the circles of your natural network? That is the challenge. So therefore, you have to embed the smaller players with a distribution excellence.
And then if you interpret smaller managers as also like managers who will be more like a total manager for clients, proximity to the clients. That's what they can do, honestly, and that I think that's valuable.
Mm-hmm. Yeah.
Understand the clients, talk to the clients, and then be the client's gatekeeper to the real asset managers.
Yeah. Another question: what advice would you give to smaller or mid-sized firms struggling to keep up with digital transformation? I think.
I think I said it, and I will say it again. Use outsourcing. Don't try to establish system. Don't hire 2 IT guys and think that you can make interesting things. You can't. And then accept that there will be areas that you simply can't handle.
Yeah, I agree. Focus. Focus on. I think that that's something you want in-house, but most of it you want out-house and standardized solutions.
Yeah, I think what we're running into when we have these conversations is also mid-sized wealth managers who realize they need to future-proof themselves. So there's a digital transformation element happening, but they often don't take into account the change management aspect, which is oftentimes the hardest, right?
I've seen it so often, that managers will hire a few IT guys and think that they can control the process and make great things. It never happens.
No. All right, I think we have one last one here. As investors' expectations shift, how should asset managers rethink their client engagement strategy?
And maybe we have to understand what is meant by investor expectations towards what?
That's a good question. I would say it's probably end client, right? Where their customers.
Are they changing expectations? We did a study on that some years ago and said, what will you expect in the future? So we asked young people, so what will be important for you in the future? We thought that they would say ESG. They didn't. We thought that they would say apps or whatever. They didn't say that. I'm not more than any other people. I was surprised to see that. So I would be interested to know what are the changed expectations that they have. I didn't see it.
Yeah.
I didn't see it.
Yeah. Perfect. Let's end on that. I think we are all out of time. Thank you everyone for joining. Fantastic to have you here. Special thanks to both Jacob and Jesper for taking time out of their day to offer such insight to us. We'll be back soon with another live webinar at some point in the upcoming year. Thanks again for joining, and we'll see you again next time.
Thank you.
Thank you.
Thank you.